Friends, hello and welcome to another episode of The Legal Breakdown. This is our second episode, and last week we started trying to do a legislative update and a few other things, and we plan to continue that as a trend. However, we're actually going to forgo that today for the second episode because we have so much content that I want to be able to share with you directly. Today's episode name is Getting Lost in the Weeds. There's a common expression people use of don't get lost in the weeds. It means don't dwell on the details, don't get too far off, stay on topic, talk about the high-level things. Well, we're going to do that just a little bit differently today, and in fact, we're going to get lost in the weeds because our conversation is medical marijuana in the state of Oklahoma. So what is some of the background that you need to know about this? Well, for those that aren't aware, number one, last year, June 26th, 2018, Oklahomans passed State Question 788. That was done at the ballot box in the primary election for last year's gubernatorial year, and it passed rather overwhelmingly with 57% of the vote. It was only 7 months ago. So how much is this set in stone? It's not at all. And that's one of my first things I want to touch on is a big disclaimer everyone needs to be aware of, that this could easily change. The rules we currently have in place are interim rules, that there is no permanent order on these things. We easily could see a shift going forward. What could that look like? I can't say. But if you're making a decision as a business to go down the path of operating any type of dispensary, transportation, packager, or growery, just be aware that, things are in limbo. This is a complex topic. That's why I want to dig into it. That's why I want you to understand it. But, you need to get professional advice, not this episode alone. You need to go out and obtain advice from an attorney who's well-versed in this or from an accountant who's very well-versed in this. And realistically, you need both. So I'm going to give you the disclaimers that this is complex. We're going to try to break it down, but you need to be aware of what's going on. I'll be really honest with the public. There's a lot of people out there who are already doing it wrong. I looked up, and there are 63 pages of growers already licensed in the first 7 months. There's 53 pages worth of dispensaries already licensed in the first 7 months. And I can look through and see the types of entities they're using and already know that you're going to know by the end of this episode why some of that has been a concern. So before we can dig too far in depth with regards to businesses that operate, marijuana businesses, you need to understand businesses in general. So we're going to start off just talking a little bit about the same things I would coach any small business entity on. Then we're going to get much more specific, and we're going to dig into marijuana-related enterprises. That's what the federal government calls them. Sometimes you'll see the acronym MRE, or maybe marijuana-related business, MRB. So if you hear me say those, that's what we're talking about. But so let's start out at the highest level, and you need to ask yourself if you plan to go into a marijuana-related business. And again, this could be transportation, this could be packaging, this could be growing, this could be dispensing, the retail end. If you're any of those things, ask yourself the same question you should ask any business. How am I going to be profitable? How am I going to be different? Well, just because there's a new market out there doesn't mean it's not going to soon be flooded. I mentioned 60-plus pages of licensed businesses. We're working our way well towards flooded. So are you going to have a unique product if you're a grower or a dispensary? Is your product going to be better than the others? Are you going to compete on price? Maybe your product you can sell at a lower rate because you buy in bulk, you buy in volume, you're able to cut some of the normal costs out of the process and make it more efficiently. I don't know what the answer is, but if the only thing is, I think this is a new business area and I think I could be profitable, many people in history have tried that, and they usually end up in bankruptcy. I'd give you the most recent example in memory in Oklahoma, and that would be vape shops. It was new on the scene. E-cigarettes were rising with production and popularity. We had an e-vape shop on every corner. Well, if you look around now, it's a much more mature market, and many of those have gone under. You don't want to be one of those that goes under. You need to have a business plan. That's true for any business, not just medical marijuana. Okay, so then what kind of business are we going to be? And I don't mean that philosophically. I mean what's called an entity type. Do you plan to be a sole proprietor? Do you plan to be a partnership, C corporation, S corporation, LLC? Now, right now, remember, we're not talking about marijuana specific. I'm just talking about in general. For any business, you've got all these different types. I'm going to go ahead and just make things simple and short. You should never be a sole proprietor. You should never be a partnership. There's no reason to do so. Number one, you're not going to have limited liability. That means that if you get sued, that lawsuit, that resulting consequences, the judgment will be on you or your partners. It won't stop with the business. They can come after your assets, come over your personal home, your vehicles, your savings. You don't want that. So there's no excuse. Never be a sole proprietor. Never be a regular plain general partnership. Okay, so we made that simple. That leaves LLCs, C corporations, and S corporations. There's more types. True, you've got limited liability partnerships, some other unique things. We're not going to go into that too far because we don't have time in the scope of this program. But what are these? Well, an S corporation has rules that make it more restrictive than a C corporation. It's got some advantages. It's got some disadvantages. An LLC, on the other hand, doesn't have some of the benefits of a C corporation with regards to number of members, the ability to raise capital, being a publicly listed stock, or SEC regulated. So we're not talking about massive business ventures here, such as Walmart, but it does have flexibility. It doesn't require corporate minutes. It doesn't require a board of directors, those types of things that we see with a C corporation. So let's dig into the question of taxes on these. That's the starting point. We've already established that a C Corp, an S Corp, and LLC, they're all going to be protected the same for legal liability. What about taxes and tax liability? Normally, with a small business, we would advise avoiding a C corporation because it is the only one of these that has what is known as double taxation. It pays taxes, and then the extra profits received by ownership, they pay taxes. On the other hand, with an LLC, it can be taxed either as a default partnership or an S corporation. So as far as taxes go, LLC is not a thing by itself. The IRS doesn't recognize an LLC as an entity type. So if you're taxed as a partnership, you're going to pay self-employment tax, just like if you were a sole proprietor or a partnership. That has some downsides. If you took an S corporation election, the advantage is you can reduce your tax basis. Okay, so we've started to dig in and identify in the first third of our show. Number one, we've talked about the history of medical marijuana. Then we got into general business structure. We've talked very quickly about you should have a plan. You're going to have to pick what type of business you want to be. Typically, if you change your mind down the road, you could change. You could reorganize. You could go down the road differently. But one thing out of the gates I want to explain about Oklahoma law is that won't be an option if you are licensed on any of the things we already discussed, grower, dispensary, transportation, or producer. Very specifically, you would have to get relicensed. You have to go through the process all over again. So you probably don't want to do that, meaning you're not going to ever change entity type. We need to get it right out of the gates. That's why we're talking about it right here, right now. So if you already have a business in Oklahoma and you're licensed and you're a sole proprietor, and you just heard me say you should never be a sole proprietor, that's true. Maybe you want to consider changing your licensing. You should speak with counsel. You speak with an accountant. But the reality is if you're any of these businesses, you have taken massive liability on yourself if you're a partnership or if you're just a sole proprietor. Well, then, what about some of these other things? Let's dig into the specifics of marijuana-related industries, marijuana-related businesses. We just touched on that you cannot change entity type, and that is going to be in the Oklahoma Code or Oklahoma regulations under what is 310-681 Part 681-1-4 Part C. So I recommend anybody look these up, but I give the caveat again, they're changing. This is the third revision to the emergency rules. Some pretty major changes have already gone into effect. For example, at one point, you could not have any employees under the age of 21 and they all had to pass a criminal background check. Under the current version of the rules, No criminal background checks. They have to be over the age of 18. That's a pretty substantial change. We've changed it from, down from 21 to 18. In addition, we removed the criminal background check. So previously, you could not be an employee of any marijuana-related business in Oklahoma if you didn't pass the background check. Now you can. But could it change and come back into play? It's entirely possible. With 7 months in, rules have already changed 3 times. So number one, you can't change your entity type. Make sure we're paying attention. We get this right out of the gates. Okay. What are a few of the other details I want to point out and bring to your attention as far as marijuana businesses? You need amazing record keeping across the board. Your inventory, your taxes, your sales, your audits. There's 2 reasons you're going to need that. For the government, for taxes, for the IRS, which we're going to get to very in-depth, and you also must have it as the requirements for your license with the state of Oklahoma. You are going to be responsible for your inventory, whether you're a grower, whether you're a seller. If something comes up missing, you might want to identify, was it stolen by your employees? Did somebody break in and you didn't realize it? You need great record keeping. This is going to fall on you. If you don't have good record keeping, if you fail to produce this or they've got problems, it can start with fines. It can escalate from fines to losing your license. It could even turn into a criminal referral. You lose product, you can't account for it, they think you're selling it under the table or you're engaging in black market enterprise, you could end up with a criminal referral. So this, I would just say there's a lot of businesses you can get away with subpar accounting. I don't ever recommend having subpar accounting, but believe me, I have counseled many, many, many people who their taxes weren't on the perfect up and up. This is not one I would recommend that. If you are not an organized person, if you don't want to have a system, if you do not want to use computers and record keeping, stay away from medical marijuana. That's just my personal advice to you. It's not to say you couldn't do it, but you're going to bring some serious liability on yourself. Security. Whether you're a grower, whether you're a dispensary, for the most part, if you've got a loss, it could end up on you. It very clearly in the law says that you've got to have adequate security protections, whether that's alarms, cameras, doors. The problem is what defines adequate security. Since this is new, we don't have case law on the topic. This hasn't gone to the Supreme Court. Is it a question of I must have armed guards 24/7? Do I, 6-inch thick metal door? Can't tell you exactly other than you need to be prepared to invest the appropriate amounts. You need to be realizing that if you have loss, you've got a duty to report that within 24 hours and, it could come back on you. So you need to have great security. What about banking? Well, for most businesses, that's no issue. We happen to be in the Arvis Bank Tower in Del City. I could just walk downstairs. I can open an account up. It's not so simple when it's a violation of federal law, though, is it? Schedule 1 is where marijuana is contained. The federal government, as we all know, considers it an illicit drug and that the sale proceeds of it is drug trafficking. So because of that, the Financial Crimes Enforcement Network, FinCEN, could crack down on any bank that has proceeds from a marijuana-related business. There are banks that will do business with you. I do not have a list, but I would encourage you to continue to look. You don't want to be an all-cash business. That is going to cause all sorts of additional security problems. It's going to make you a target for burglary or robbery or just personal violence. Avoid operating exclusively in cash. And we're going to get into also some of the ways you can avoid operating in cash. But be aware that you likely will have a lot of difficulty walking into a bank and telling them, hi, I'd like to open an account for my new marijuana business and put cash in it. Especially your larger institutional banks will balk at that. If the bank is not federally regulated and is only an Oklahoma State bank, or if they're smaller or a credit union, they may be more inclined to work with you. But that is just anecdotal. That is my personal statement. You can't take that to the bank. Haha, pun intended. Okay, let's dig into the issue of taxes. We've used up half our show. That's on purpose. The other half is where we're really going to get lost in the weeds. So the concern for you, if you go into this business, is basically 2-part. Liability, which overall we've addressed by one of our 3 suggested entity types of LLC, S Corp, or C Corp. If someone sues those businesses, so long as they cannot do what's called pierce the corporate veil or establish alter ego, which we're going to touch on in a bit, they can't come after you. So if I own an LLC, my LLC gets sued, that doesn't end up causing me to lose my house. So that's going to help you. And then we got to get into the question of taxes. And the taxes is very important because you do not want to get audited. You don't want to lose all that money. And obviously, it's going to make you more or less competitive. If you're paying less taxes than somebody else, you can have a better profit margin. You could maybe charge a little less for your product. These are the issues that go to where I said, how do you separate yourself from the pack? Truth be told, if you want to just pay taxes on every dollar you ever see, you're not going to incur all that much trouble. I mean, we're all welcome to pay more on our taxes. The IRS will not mind if you fill out a Form 1040 tax return this year and you say, you know what, I don't want to take any deductions. I don't want to take any depreciation. I just want to pay everything I can to the IRS. Hey, you're welcome to do that. Although I think most of us are probably frustrated the government was shut down for 9.5% of a calendar year. You also, unfortunately, can't pay 90% of your taxes because the government only worked 90% of the year. I have a feeling that's going to get you in trouble. So if you are even considering going into a medical marijuana business, the first thing you need to look up after you get done looking at all the Oklahoma rules, the first thing is read the Oklahoma statutes, which is 63 Oklahoma statute 420A. Yes, they did that on purpose. Ha ha. 420. 63 OS 420A, you need to read that. You need to read all the regulations promulgated by the Oklahoma Medical Marijuana Authority, OMMA. That's what I was just holding up for those of us that are watching this live. Again, though, they've changed 3 times. You're going to get your license. From there, where do we go? Well, if your first stop wasn't a lawyer's or an accountant's, probably a good idea, but you need to look at 26 USC 280E. We're just going to call that 280E. This is the big fun one that pretty much says you can't write off or take any deductions for your otherwise illegal business. I'm going to read it to everybody. No deduction or credit shall be allowed for any amount paid or incurred during the taxable year in carrying on any trade or business if such trade or business or the activities which comprise such trade or business consists of trafficking in controlled substances, which is prohibited by federal law or the law of any state in which such trade or business is conducted. It's a bit of a mouthful, but it's pretty straightforward. No deductions or credits. Okay, well, so what's that mean, Jason? Do I have to pay on every single dollar that comes through the door? Well, no. That leads me to another thing I strongly encourage everybody look up and read in its entirety. We obviously don't have the time to read it to you in its entirety. The Internal Revenue Service issued a memorandum in 2015 on January 23rd. The number for this, though, is 2015 04011. This is the official publication from the IRS on basically how you're going to be taxed. You can take out what's known as cost of goods sold. And the reason being is that although a medical marijuana business is illegal under federal law, it remains obligated to pay federal income tax on its taxable income because federal law does not differentiate between income derived from legal sources and income derived from illegal sources. I'm reading that directly from a United States Supreme Court case in 1961, James v. U.S. So even though your proceeds may be illegal, you have to pay taxes on it. In fact, for those that know their history, that's how we got Al Capone. Al Capone didn't go down for all the other crimes he did. He went down for not paying taxes on the money he made from the crimes he committed. But this gets to our point of what's called COGS, or cost of goods sold. The Supreme Court has held that income in the context of a reseller or producer means gross income, not gross receipts. In other words, Congress can't tax the return on capital. Several cases have reiterated that. To quote one of the seminal cases, which is New Colonial Ice Company v. Helvering, it's a 1934 case. We're going back a little bit. The power to tax income like that of the new corporation is plain and extends to the gross income. Whether and to what extent deductions shall be allowed, though, depends upon legislative grace. In other words, we can tax you. We can't tax you on all of the money. We don't tax you on the gross income or the gross receipts. We tax you on your gross income. Beyond that gross income, though, it's up to Congress to decide how much you get to deduct. And we all know that. Well, we've got blanket deductions, we've got itemized deductions. Those are what is known as legislative grace. Well, the problem is it's more like the opposite of grace, because 280E that I already read to you strips you of all that legislative grace. They give you zero grace. They're taking away pretty much everything, okay? Well, so what can you do? To cut to the chase, if you are in any of these industries, first off, you must use the accrual-based accounting. Now, there's two types of accounting commonly utilized. People may or may not be familiar with. You've got cash-based accounting and accrual-based accounting. It's beyond the scope of this. If you're not familiar, do a little research, talk to a CPA. Do not be cash-based accounting in a marijuana business, because you will not be able to write off your cost of goods sold. You must be accrual-based accounting. You must use an inventory system. So the reason being is if you don't, we can't get any benefit. So got to have an inventory method, got to use accrual. What does that ultimately add up then to mean? What can you do? And again, this publication is very long. I suggest you read it as whole. We're glossing over the high points, but, and I quote, a marijuana reseller using an inventory method would have capitalized the invoice price of the marijuana purchased, less the trade or other discounts, plus the transportation or other necessary charges incurred in acquiring the possession of the marijuana. Similarly, a marijuana producer using an inventory method would have capitalized direct material costs, such as seeds or plants, the direct labor costs, and what are known as Category 1 indirect costs. So you're not going to get the ability to depreciate the building. You're not going to get Section 179 deduction schedules, but you can get some things. So it's important that you know what that is. Because if you try to conduct this like any other business or like your personal income tax and you start to write everything off, you're going to get audited. And when you get audited, you may owe a lot of money. Well, this circles back to the initial point of what type of entity type should you use? With an S corporation and an LLC, the federal government can compute or impute that tax liability back onto the ownership or the members, meaning you may be personally on the hook. With a C corporation, that's much less likely. With C corporation, even though they're going to hit the tax burden on the business, and the business may have to fold, you're not going to be the one on the line for that. So that's one reason why we're going to ultimately recommend C corporation. The other reason I recommend is ultimately the tax rate. So we talked about all these things you can't write off. Well, normally, if we're an S Corp or an LLC and we're paying business salaries, we might be able to have less tax basis than a C corporation. The problem, of course, is Rule 280E won't allow us to write off those extra expenses, including some of those salaries that are not directly related to the production. Your marketing department, can't deduct them. IT department, can't deduct them. Oh, just the CEO whose job is not directly related to the manufacture or the buying and selling of the marijuana? Nope, not a direct expense. Can't write that off. So we're going to lose some of the value we normally see in an S corporation or an LLC. Historically, you paid a lot of double taxation on C corporations, but the beauty is we had reform in 2018. It was known as the Tax Cuts and Jobs Act, or TCJA. Under the Tax Cut and Job Act, it changed the tax rate for a C corporation from 35% down to a flat 21%. When we take that into consideration for a medical marijuana-related business, it tells us we should be a C Corp, especially when we already considered our personal liability and the potential tax liability that could be imputed back on you. Okay. Well, what about banking? How do we get some of the deductions we'd like to have but we couldn't have? This leads to another point that is commonly used in industry, and that is you set up more than one business. Now, I'm going to touch on this very quickly because we've slightly around 5 minutes left in our show. This is normal in asset-related businesses such as construction, where we have a lot of liability, though, for the work we're doing. You have one company who owns all the what we call plant property and equipment. They're going to own the dozers, the tools, the earth movers. Then you have the service company that does the actual work. They go out, say they build a home. You lease from your asset arm all of the equipment. So when that house falls down or you get sued or you screwed something up, the lawsuit is against the service company. They don't have any equipment. They file bankruptcy and they go away. But the ownership still gets to keep their $1 billion worth of dozers that is unrelated. Overall, that can work in the marijuana industry as well. You and your group of investors, you start a business. They're going to own a building. They're going to own lights. They're going to own water dispensing equipment, power, all the things necessary to manufacture marijuana. But they by themselves don't have to be licensed because they are not manufacturing marijuana. They just have a building capable of it. That company, number one, can get a bank account. That company could file taxes and take advantage of the full relief of the United States tax code. So that is going to be advantageous. Oh, by the way, we glossed over this, but I should mention, even though the federal government is going to stop you from taking advantage of certain things, it's to be determined what you can do under Oklahoma state law, because we've only had 7 months. We just started tax season on the very first year in which anyone would be filing a return. I don't have a perfect answer as to can you maximize other deductions in an Oklahoma state tax return. Most states, though, the answer is yes. You can take greater advantage than you could under the federal code for the Internal Revenue Service. States like Colorado and Washington, you will be able to be more successful in the tax fight at a state return. But we're talking federal. That's the real concern. So we addressed on 280E, we don't get these deductions, okay? We can take out cost of goods sold. What equals cost of goods sold? It's complicated. You need a CPA, but you must realize that you need to have an inventory system and you must be using accrual-based accounting. Oh, by the way, you should already have that inventory system because if you don't, you're probably in trouble with the things we talked about as far as the state, the audits, the records. You don't want to have criminal referrals there. In the last little bit of time where we've talked about the fact we're going to have multiple entities, we're going to have 2 entities. I recommend that the one that is actually licensed producing the marijuana be a C corporation. The other one doesn't have to be because we have different considerations. It's more of a normal business. It could be an LLC taxed as an S corp. It could be a regular S corp, or it could be a C corp. Personally, I'd recommend an LLC taxed as an S corp for our ownership asset arm. I'd recommend our separate entity be a C corporation. You need to be aware of what is known as alter ego theory, or alternatively called piercing the corporate veil. Oklahoma Supreme Court case, for those doing research or want to just have too much fun on their weekend, look up Penmark Resources Company versus the State XRL Oklahoma Corporation Commission. It is a 2000 case, but it reiterates some points to read only one of them. There's 10, but here's the most important. Legal formalities for keeping the entities separate and independent are observed. What does that mean? You're going to have these 2 companies. You better have a bright line between the 2. You have to treat them at arm's length as different businesses. You can have the same ownership and commonality, but if you do not establish where one starts and where one ends, if you put money in the same bank account, if you don't have lease agreements that are clearly written in contract, if you're not literally moving the money, then the law could determine that they're just one company, that there's no clear distinction between the 2. That's a problem. That's a real problem. I've been involved with this. The litigation can get complex and it can get very fact specific. So you need to speak with counsel. You need to get advised as to how are we going to set this up. But to try to run through everything we've discussed, number one, this is complicated. I'm going to be really honest with everybody. If you're going out there and you're thinking, I'm going to get rich quick, I'm going to grow marijuana in Oklahoma, it really doesn't have any less concerns than it did before June 26th of last year. It's still against federal law. They're still going to try and tax you. You still need to realize what you're doing as a business person. Oh, by the way, it's going to be hard to get capital investiture. Normal banks aren't going to lend on this. You're looking at either angel investing or some type of private equity hedge fund type. That's another reason why C Corporation is advantageous, because C Corporation opens the door to greater forms of investment opportunities than LLC or S Corporation. Have your separation, have 2 entities, make sure that you have all of your security, your compliance, your auditing in place. be aware of what you conduct and what you can't. Friends, this has been an amazing episode. I have tried to go very quickly to cover everything we could. Remember, you can call in. Remember, you can email questions. You can comment. You can ask questions. Tune in next week. It's great to see everybody. I'm very happy to be able to